Hi, everybody. Just double checking that you can hear me. If FX Street admin could just let me know. And then we'll get going. Good morning to you, Ray. Thank you, as always, for joining. Let me just quickly share my desktop. I believe that the sound is fine. Okay, so, guys, you should be able to see my desktop now. It's got a disclaimer on it, a big fat disclaimer on it. I am aware of that, but we'll just have to go through that really quickly if that's all right. Just bear with me a moment. I'm just going to make sure I can see all your questions, and then we'll get going. So just a reminder that this webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussion of a particular market or product should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. This webinar has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient. And we do not guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leverage products, they involve substantial risk of loss, and they're not suitable for all investors. Spot gold and silver contracts, they are not subject to regulation under the US Commodities Exchange Act, and contracts for differential CFDs, they're not available for US residents. So that's that one. Oh, just one last thing, actually, I need to remind you of as well. This presentation will use both Forex.com charts from eSignal and Bloomberg charts. Please note that Bloomberg prices displayed on the chart may not reflect Forex.com prices. So that should be enough for that. Just bear with me one moment. Oh, sorry, we're not looking at this. Let me just try and, sorry about this. It's just taken a bit longer than I'd like. But anyway, so this chart here, this is a RAND chart, and I won't spend too much on this. In fact, what I will do is use my other one. Just to show you really the type of environment that we're in right now. Some people may be wondering, well, hang on a minute, what's fueling this kind of sell-off in equities? What's fueling, some of the move lower in, in dollar yen, for example? Well, this is one of the reasons. I'm not saying it's a definitive reason, but it's one of them. This is the Indian rupee, and this is dollar Indian rupee. So the dollar has risen to another record versus the Indian rupee, or you could say that the Indian rupee has fallen to another record low against the US dollar. So even though I know a lot of you won't trade the Indian rupee, it is worth knowing what's going on in other parts of the world. The main reason for this, as I've been talking about the last kind of month or so, those of you who've been regulars, FX Roy, you're right, the rupee has been beaten too, and that's completely true. You'll also see I was actually looking just before we joined. This is the rand, the South African rand. A lot of emerging market currencies really been battered by this. And so what's causing all of this sell-off? Well, it's our little friend. Just bear with me one moment while I pull up the chart. This is a 10-year Treasury yield. Had another shoot higher at the end of last week. Lots of, Chris, I think you're talking about like kind of lots of economic stuff going on. Yeah, that's right. But as you can see here, it's the 10-year yield. It's moving higher. A lot of expectation now, a lot of speculation that we are expecting to see the Federal Reserve actually start to taper their asset purchases, as early as next month when they meet. So they meet in less than a month now. They meet the 18th of September. And there's expectations that they'll start tapering. So a new era, certainly a new era for monetary policy. And this is being very much reflected in these yields. So as these yields moved higher, in fact, let me just make a quick chart. Oh, bear with me now for a second. So that's the 10-year Treasury yield, and I'm going to do the Indian rupee against the US dollar. Just finish that together. And as you can see, they've pretty much been moving lockstep with each other. So obviously we have seen Treasury yields just back off a little bit today, because yet again, even as we've seen even more, even more stress really on in emerging markets. That's causing kind of an overall kind of risk off sentiment, and even that's starting to have an impact on the Treasury yield. So kind of what we're seeing at the moment is today is a bit of a strange phenomenon. So we've seen rising Treasury yields be one of the main reasons for the decline in the rupee, as you can see in this chart. The orange line is dollar rupee, the dollar versus the rupee. That's been shooting higher really since April. And the other one is the 10-year Treasury yield, which is the white line on this chart. And as you can see, the two of them are following each other higher, very much in lockstep with each other. However, today, it seems like that decline in the rupee has actually caused kind of, a broader risk-off sentiment in the market. And we've actually seen some pressure on Treasury yields, and they've even been affected by this risk-off sentiment and are acting more as a safe haven. Now, the first kind of currency I want to look at quickly is actually dollar yen, because we could be looking at something. We could be looking just in a bit of an easing up of sentiment, a little bit of a turn of sentiment. I'm going to give you just the intraday chart here to start with. As you can see, we had gone sub 97 at one point. Since then, we've just recovered just a little bit. So I'm going to just monitor this. Obviously, there's in no way do we look strong or healthy. This is a perfect chart to show you that the trend is down in the very, very short term, and it still is down. But that 97 level, it's got some significance from a psychological perspective. It's a round number, and we know that it's been a support zone in the past. So one thing that we do need to do is get above this 97.40 level. That was the prior high. It's also the daily pivot. So it's a key short-term resistance level. Remember, below the daily pivot, the market tends to see it as being quite a bearish development. So we do need to get above there before I get too excited. But one thing I would say though is that it looks like we might have just made a bit of a bottom here, and I'm looking to see if we can extend gains above 97.40 just for a very mild short-term recovery. Now, I don't necessarily think that today is going to be the day whereby we get big directional movement in markets. Now, obviously, famous last words. And you can all come back, not next week, 'cause I won't be here, but the week after, if I'm incorrect, and that there are big directional moves today. But I think the market is going to be fairly quiet into tomorrow. Now, that doesn't mean that you can rest on your laurels and not really care about what you're doing. No way. Tomorrow's a massive day. We've got the Federal Reserve minutes coming out at 7 o'clock London time in the evening. And then on Thursday, of course, we get that really all-important economic data. So there is a lot going on. But one thing I would say here is that today, on a day like today, it doesn't mean that you hang up your boots. You don't need to do anything. It's more just about kind of like catching the worm, if you like. Just looking for things like this. Like, a move above 97.40 here could take us back to maybe those 97.80 highs. That from 3 a.m. this morning. It could just suggest just maybe just a little easing of risk negative sentiment in the market. Now, obviously, kind of those of you with a slightly longer term bias, as you can see here, we're still looking fairly weak. We're very much trading in a range at the moment. One thing I want you to notice from this chart, we've got a series of lower highs. However, we've got a series of higher lows. That's your typical that is your typical triangle pattern. So really at the moment it suggests the market's going neither one way or the other, and you can really tell that because we've had a real narrowing of the candlestick. So it suggests that maybe we're not going anywhere too fast, or the market is not that directional at the moment. And for us to be kind of excited by this pair, we need to get above this level of resistance. Let me just draw that in for you. We need to get above this key level of resistance here, which also coincides actually with that 50-day moving average, and then obviously there's the 100-day moving average too. So that 30 to 70 level, or 30 to 90 level, sorry, I should say, a massive level of resistance there, and that's really thwarted the upside so far. So we'll be watching that very, very closely, just to see where potentially it could go. It could potentially go next. So. If we get above there, then, that's quite a bullish development. We can get back to 100. But for us, it's going to take a massive push by the bulls to get us above there. And I just don't see that happening in the next 24 hours. In the next 48 hours, though, it may do. It depends what's in those minutes. This cross, whenever you talk about Fed policy, someone's asked me to look at gold. I will. Just bear with me. I will after this. Whenever you look at Fed minutes, you've got to look at dollar yen. Changes in monetary policy in the US has a huge impact on dollar yen. And right now what we've seen is that dollar yen hasn't really followed treasury yields higher. So remember the chart I just showed you? Treasury yields been moving higher. Dollar yen's actually been coming off. So we're looking for that relationship, that divergence to narrow, that relationship, the positive relationship to follow, to go back yet again. And for us to, and basically for that to, essentially depending on what the minutes say, for us to push higher. Now, someone's asked me for gold, and I'm very happy to look at gold because obviously it does feed into this. Gold has been an interesting cross. Again, it looks like it's in a nice kind of uptrend now. Looks like it's certainly, it looks like it's certainly kind of moved higher. There are a couple of things driving gold at the moment. Number one, obviously fears about the end of QE, or QE tapering, if you like, from the Federal Reserve. There's also fears about that kind of cash crunch in China, and of course also fears about an economic meltdown in India. Likewise, places like India, whereby their currency is absolutely being shot to pieces, they've also got quite high inflation. And remember, gold is an inflation hedge. So even though the West doesn't have an inflation problem, some countries do still have high levels of inflation, and that can also combine that, for example, with currency crisis like in India, and you can get demand into gold. So what we've seen here, a lot of demand in the last few days, some big pushes higher. We've heard some news that exports to emerging markets, particularly to consumers in China and in Sarah, I just looked at dollar yen actually, so I won't look at that again. But if you've got another idea, if you've got something else you'd like me to look at, I'm happy to do that. I'll just recall that dollar yen, as I said, I think in the short term we can see a mini recovery to 97.80, but from above there we've got to get above 98.30 for us to be in any way type of bullish mood to get back to the 100 level, and potentially that may come depending on what's in the minute, Sarah. So that should be enough for you. But back to gold now, as you can see, it had some nice move higher. I'm just going to draw a little trend there because obviously we are in a bit of an uptrend. It certainly looks like we've reached the bottom, that's for sure. But we are running into a little bit of resistance, even though we think this could potentially just be some short-term resistance around about this 100-day moving average, which comes at 1371. We would fully expect that to be a sticky zone, especially on a day like today when risk is off and stocks are coming off. Stocks and gold, they don't have a fantastic relationship, but when you see big drops in stocks, you tend to see the gold price can fall alongside that. So that could be kind of one of the reasons there. As you can see just from this, just looking at this, quite simplistic channel that I've drawn here, 1400 is the level to beat. Above there, we then have this 1420 level, and then obviously 1490, which is the high from kind of April. So they're the levels that we're looking at. Someone's just asked me what terminal this is. This is a Bloomberg terminal. So as I said, it won't necessarily be reflective of the prices that we offer at forex.com. Roy, I know you want me to look at cable, and I will do, and I'll also look at oil. But basically for us with gold, I see it maybe, potentially getting back to the 1350 level, but I do think it's still supported. There's very good support there, just kind of around about 1310-ish. As long as we stay above there, then we could potentially continue to move higher. I'm going to look at cable now, and then I'll look at oil. As you can see here, cable, it looks fantastic, right? We saw another Paul, I just mentioned that I did think the gold has maybe made a bit of a bottom, a medium-term bottom. So that drop below 1300, I think really is a medium-term bottom. I think we could, I'm not saying that we're going to actually shoot higher and get back to 1900. I just do think that there's the price action, the chart. I'll just go back to it really quickly, and then if you want to ask a question, please do ask a question while I'm talking, so that I don't move on to different things. So that we're all on the same page here. But as you can see, very good support there at 1305. I do think that kind of, this is certainly below 1200 is a medium-term bottom. I also think kind of in the short term, 1280 is the bottom, and that we could actually move higher from here. It looks quite nice. Obviously if we get below kind of 1350, I'd probably be a bit more concerned. There could be a bit of a deeper pullback, maybe to that 1305 level. But I do think right now that there could be, especially with Someone's just said, can we look at gold in 3 days at 1470? I don't know. I mean, you've got to think potentially about gold. What are the risks to gold at the moment? Well, one of the risks is obviously, as I said, the positive risks seem to be demand from the emerging markets. We think that's going to be in place for a while, which could certainly support the downside. But in the very short term, over the next kind of 2 to 3 days, there is actually probably a risk factor with gold. That's because we get those FOMC minutes. We also get a big central bankers conference up in the US. Potentially signs that, QE is coming to an end in September. That could potentially be gold negative, because that, QE is considered inflationary, et cetera. So in my view, I think actually the gold could just, I don't necessarily think, I think there could be a bit of hesitancy to get us above 1400 until we at least know what's the content of those minutes. And really, whether or not we get above 1470 in gold, I think will probably depend on the severity of problems in the emerging world. We haven't had any credit downgrades yet. It looks like we're not going to get them. Obviously, if we do get kind of another shock, or things don't pick up there, I'm not saying it's in a good way, but whether or not we get to 1470, I just don't see it in the next 3 days. I could see it much more likely actually in the more medium term. But as I said, this 1470 to 90 level, these highs from April, I mean, that's a massive resistance level, and you need to get over 1420 first. So I would probably say don't run before you can walk. Okay. What happens if dollar improves? Usually when the dollar strengthens, so if it strengthens on a broad-based basis, that has a negative correlation with gold, because gold is priced in dollars. Now, that's not the be-all and the end-all. We've certainly seen gold rise and the dollar rise in the past. So it's not a perfect, it's certainly not a perfect thing to trade. So, for example, today, gold has come off, even though the dollar's been under some pressure. So it's not, a fantastic way to move, to necessarily look at things. Okay, so Roy, I'm finally getting back to cable. Let's just concentrate on cable now. Obviously, it's been a big couple of weeks for cable, as you can see. Huge move higher, but this is a daily chart. Let's go on quickly to the weekly. We are getting caught up here in this massive congestion zone. That is a slight worry to me. 157.50 is the key level that you're going to be looking at. That is the yellow line on this chart. It's the 200-week moving average, and that seems to be capping the upside. Now, it obviously also coincides with those highs from July. One thing we have seen, obviously, is that the pound can be quite brutal. It can move very, very fast. We've seen, this is a weekly chart. So pretty much over the last 8 weeks, we've only had 1 week of negativity in the pound. Other than that, it's all kind of pushed higher. It seems like since Carney has joined, cable has been bid, and we've seen it move higher. However, one thing that we are aware of, as I said, is that we are nearing this massive resistance zone. So we are a bit nervous. I think if we see tapering in September from the Federal Reserve, I think it's going to be pretty hard for the pound to, extend gains maybe back to that 160 level here. That would be the highs from kind of earlier this year, very early this year, January to February. So what we're seeing instead maybe is just a bit, I would say, I'm not going to go one way or the other, because I think that, I think the next couple of weeks could be more maybe trading sideways in cable. I feel like potentially we got we've reached saturation point maybe in this move higher, and 157.50 certainly stem the bulls. That could be a good short opportunity for some people because it's such a massive level of resistance. As you can see here, this is a daily chart on cable, and the reason why I'm showing you this chart is because this is an RSI, it's a relative strength index, which just suggests, we're not there yet, but we're really on the cusp of being in overbought territory. So yet again, a pullback around about this level ahead of 157 or 157.50 would be very, very normal. People will start to kind of book profits. Added to that, this week and next week, they're two very illiquid weeks in the UK market because we have bank holiday on Monday. So what you're seeing here potentially is, or what you could see is just people closing up positions, if they're going on holiday or if they're not going to be in the office on the Monday. That doesn't, or these days, that doesn't have a huge impact on the market, but it's certainly one to watch out. And as I said, I'm just a bit aware that we are looking overbought a little, and that we're also heading up to that key resistance level at 157.5. So to me, that's like warning signs that, hey, uptrend might be about to take a pause here. and we may actually see some profit taking for sure. Great. There's a little bit of a debate going on about what's the best platform. I personally like Bloomberg. I've always used Bloomberg throughout my career, and that's why I choose to use it. It's easy to use once you know all of the codes, which I do now, weirdly. Anyway, let's take a quick look at euro, because this is interesting, right? Euro dollar, again, nice push higher, getting very close to that 134 level. However, 134 between kind of 134.05 and 134.20 is a very big resistance zone. So I just mentioned my cable outlook, Nabil. Let's look at euro now, shall we? So 134.20 is a massive resistance level, and we are kind of testing up here now. As you can see, we're currently at 133.80, the highest level in a good couple of weeks. Be interesting to see whether or not we reverse the same way that we did last time. So earlier this month, we again saw a nice kind of move higher in euro. Sorry, just for 1 minute. We saw a nice move higher in euro, and since then we've just kind of reversed lower. So that's been that's kind of again another warning sign as we get to that 134.20. Obviously, you know, when you get to these kind of big resistance levels, a few things can happen. You can either kind of hover around it, you can reject it and move lower, or you can just kind of jump higher and continue to move higher. Right now with the euro, I think there are, you know, momentum. There's a few things I'm going to point out to you. Momentum, you know, obviously seems to be on the upside. You know, it's definitely on the upside, but beware, we are getting into overbought territory. We're not there yet, but we are potentially near there. You know, as you can see here, we're currently around about that 65-ish level. Anything above 70 considered overbought. On the daily chart, obviously, let's take a quick look on the hourly. Again, also now above there, so looking very overbought at the moment. This isn't the be all and end all. This is just a nice thing to complement your other research. Obviously, you know, the fact that we're approaching that 134 level is a key thing as well. And let me just get here. Actually, it'll be easier on my Bloomberg chart. Just bear with me 1 moment. This level as well, look there, 133.85. We're currently testing that. That's the 200-week moving average, a massive level. If we get above there, that's a very bullish development. So I would just say, you know, as I mentioned, to me, this is, if you don't have a euro position already, then it's probably one to just wait and see where it goes from here. Because obviously this is a key level of resistance to contract some selling interest ahead of that 134 level. We also tend to think as well that 135 is going to be a bit of a level where the ECB might start to get a bit worried, and may try and talk down the currency. Now, one thing we did see yesterday was quite a hawkish Bundesbank in Germany, but they do tend to be quite hawkish anyway. So that's kind of no surprise really. So what we're, you know, I would just be a bit wary here about instigating longs, because of the vast amount of resistance that we're seeing, and the fact that we're close to being in overbought territory. Now, if you joined kind of the euro bandwagon around about here at this 130 level, you're looking at some nice profits. Some people will choose to book them ahead of those FOMC minutes if they think that the FOMC minutes are going to, you know, really cause if they think the FOMC minutes are really going to push higher and cause a nice recovery in the dollar. So on that note, I'm going to look at the dollar index. As you can see here, dollar index, again, it's found a nice bit of support there, just around about that 81 level. 81.60 is really the level to be, and we're currently at 81.05. So as I said, we seem to have maybe potentially found a bit of a bottom potentially found a little bit of a bottom there in the dollar, but we're certainly not extending gains to the upside at the moment. Someone's asked me about oil as well. I forgot about that. Yes, let's talk about oil. So this is important though for oil as well. So gold, so with the dollar, you know, obviously the lack of follow through on the dollar, the lack of upside is kind of impacting, obviously the FX space. We've seen, the euro do well, the pound do well against the dollar. And then equally, we've seen kind of gold do well. So some commodities have an impact as well. Let's take a quick look at Brent, WTI first. Brent oil is quite interesting. You've got a couple of things going on. We've seen a pickup in the economies of Europe, of the US, of the UK. We've also got problems in Egypt, fears about kind of oil transportation in the Suez Canal. And then kind of on the back of that, you've also got this kind of slowdown and concern in the emerging world. And that's where the bulk of, demand was set to come from. And yet we've got a slowdown there. So that's really leaving oil pretty much range bound, I think. Now, one investment bank that is known for kind of calls on commodities for sure is looking for oil back at 115. That's WTI oil back at 115. But we've kind of, it looks like we've just kind of given up on that kind of 112 high. That was a key resistance zone anyway that goes all the way back to kind of April this year. Given up a little bit on that, but we do have good support there in Brent at 108.25. That is the 200-day moving average. So we would expect that to hold. If we don't, then we'd expect a further decline, maybe back to those 105 levels, which we'll say 106.80, which is the 50-day moving average, and then 105, which coincides with the 100-day moving average. Now I'm also going to show you the Ichimoku cloud on this. We're still well above the cloud. We're still in a bit of an uptrend, but we are testing some key resistance. This is the Tankan and the Kijun line. Don't worry too much if you don't know too much about Ichimoku. Basically, just treat them as a bit of a support level. So this support level around about kind of 109 to 108.80. We're just above there at the moment. But if we are to get daily close below kind of 108.60 to 70, that would be quite a bearish development that could see us lower. In the more medium term, though, this 106 level, top of this daily cloud, massive support level. If we get below there, it kind of ends the uptrend. But as I said, I think you're right. Whoever said it, I can't remember, but they said, oil seems a bit confused right now. Indeed, it does. I'll take another quick look at WTI. Oh, no, that's the wrong one. Sorry. It's a volume monitor. WTI is pretty much trading in a similar way. It's pretty much trading in a similar way, very much range bound at the moment, and the upside has been capped just below that 10 level. But yet we're still looking like we've got probably some good support. 105. If we get below there, then kind of 103.50. That's the key level. Okay, well, it's coming up to 10:30. I'm happy to take one more question, if anyone has any. I'll just give it a quick lowdown of Aussie, because what we've seen today is some minutes come out in the Australian dollar. Oh, there you go, Ty. That should be good. And that's really caused a reversal in Aussie. So remember, after they cut rates, we actually moved higher in the Aussie. That was the beginning of August, to a bit of a recovery in the Aussie. But since then, really, we've really declined. So that kind of 91.90 level, which is the 50-day moving average, or the pink line on this chart, that is now acting as massive resistance. And as you can see, 90 is your key level. Below sub 90 though, get 89.80 and then 88.80. So they're the levels to watch. Terry, I've already gone through euro dollar, so I won't do that. Go through that again, because I did just look at it. Basically, as I said, that 134 level, 133.80 to 134.20. Massive resistance level, and could attract some selling interest, I think, probably leading up to the FOMC minutes. If the FOMC minutes aren't dollar positive, then we could see another grind higher, maybe to the 135 level. Okay, everyone, that's it from me. Thank you so much for joining, as always. And please do, next week, by the way, I'm not going to be here, but I will be around the week after. So I will remind FX Street about that, and we can move ahead from there. Okay, everyone, thank you.